Thanks for joining us. I have the pleasure of sitting here with Bill McGlashan, founder and managing partner of TPG Growth, as well as co-founder and CEO of the Rise Fund. And if you're not familiar with the Rise Fund, you should be, and not only because Bono is one of the co-founders along with Bill, but because it's the largest impact investing fund raised to date, having closed on $2 billion last year. So, now, before we start asking Bill a bunch of questions, which I'm excited to get into, I want to get a sense of who is in the audience here. So let's see a show of hands. Raise your hand if you have some sort of impact investing exposure in your portfolio. Okay. Keep it up if that was the case 10 years ago. Okay. All right. Thank you. Yeah. So seems like you might have some convincing to do.
Although it's encouraging to see so many hands did go up.
That is true. That is true. Start somewhere. So let's start with the lay of the land type of question, just to make sure we're all on the same page about what it means to be an impact investor. So define for us what you mean when you say I'm an impact investor and how you're thinking about it in the context of the Rise Fund.
Yeah, I had a very interesting dinner in Delhi with Sir Ronnie Cohen, who's considered one of the pioneers in the impact investing world. Founder of Bridges and an active impact investor for a decade, former Apex head, and a guy named Vikram Gandhi. And Ronnie turned to me and said, Bill, you've been doing investments with impact for many, many years, because I've been investing all over the world in many sectors that you'd consider impact as well as geographies, but you're not doing impact investing. So you're doing investments with impact, but not impact investing. And the difference has to do with really two dimensions. One is being able to actually commit to a social or environmental outcome that's measurable and quantifiable, that we're prioritizing alongside returns, as opposed to sort of a coincidental outcome that takes place. And the second dimension of that is the ability to then report on it. So we're focused on investments where we can deliver the dual priority of returns and social and environmental outcomes. We don't see that there's any conflict between those two. In fact, we focus on those situations where we can deliver collinear outcomes.
So there's a lot to unpack there, and I'm especially interested in that point on kind of no compromises in the return, because I think some investors that target environmental and social outcomes as well as market rate returns, they don't always achieve that market rate return. So how are you doing that when many investors can't accomplish that?
I think it starts with, in part, the lens that we come at this with. We're a platform, an investment firm that has been doing what we've been doing. We just had our 25th anniversary last week, so we've been doing this a very long time as investors across many different asset classes. And we've taken the same core team of people who've grown up over those 25 years with proven track records of engaging with companies and directed them at these kinds of companies. And the fundamental premise is that an impact company is no different than a non-impact company if what you're underwriting is the impact of a business output. So by definition, in that scenario, the more successful the business is, the more impact you're creating, because as that business scales, it creates more impact, and you get the virtuous benefits of sustainable, scalable capitalism at work in that model.
So walk us through that. Maybe you could take one or two of your portfolio companies and talk about how you underwrote both the financial component and that impact multiple.
Well, the underwriting of it was the challenge. We spent a year and a half and a lot of money and effort partnering with Bridgespan to figure out, could we actually underwrite impact in a way that would be credible with institutional investors. There's been a lot of great work. In fact, Pierre Omidyar and his organization, Rockefeller, Tideline, many groups in print have spent years figuring out how to measure impact. So we were starting with a lot of great work that had happened. Many in the philanthropic world had focused on this. So we spent a lot of time figuring out, could we do it in a way that worked for us? We had the insight that in all cases we could find, in all the cases that we were investing in, we could find third-party data that connected the dots between a business output and a return. So once we'd figured that out, we then went to work by sector finding investments where there was no conflict between the business model and those and those impact outcomes.
Is there often a conflict?
Interestingly, if the output of the business is that which creates the impact, there's never a conflict.
Okay.
So, there are trade-offs inherent within a business, but the exercise is in figuring out what is the net impact. There are negative externalities and positive externalities, but when you find an opportunity where the net effect is a positive effect, the more of that business, the better. So you asked for example, one would be a company we invested in India called Dodla Dairy, which is the fourth largest dairy business in India. And the impact underwriting there was that we could uplift the household income of the 280,000 small stakeholder farmers that are represented in Dodla Dairy. This is a business that collects milk, 1 million liters a day, twice a day, from 280,000 small stakeholder farmers. And these are the people that represent 70% of the world's poor. And by collecting it every day across 7,200 villages in 70 different collection facilities with remote payment solutions and testing solutions, we were able to commit to that daily collection over long-term contracts, and with that saw a 50% uplift in the household income of these small stakeholder farmers, and the business profited from that improvement in productivity. So you see a scaling business, it's doing extraordinarily well, while we're improving the yield from these small stakeholder farmers, and with that, you get all the great attendant benefits of healthcare and education, all the other things that people spend when they're beyond a basic subsistence level, poverty level of existence.
You said 50% uplift?
50% uplift.
Wow. And so you mentioned that the impact has to be fundamental to the business model,
That's right.
which I guess gets rid of the chance that 5 years down the line the business model change and it
That's
doesn't
right.
hit the impact threshold.
That's exactly right.
Okay, so hypothetically.
Well, the interesting insight here to those in the room that are investors or those watching this that are investors, it's sort of intuitive to all of us that investing has an impact. It's either a good impact, a neutral impact, or a negative impact, but every investment has an impact. And interestingly, some of the most important changes in the world have been driven by a commerce model. Bono famously said, it's not that capitalism is immoral, it's that it's amoral. And the notion of being able to direct capital against the highest priority investments that create the greatest impact is only possible when you have a way of measuring it, measuring the trade-offs, measuring what we're doing, whether it's government investment, corporate investment, philanthropic investment, or traditional private investment that's directed against it. If you don't have a means of understanding the relative impact of the outputs of the business that we're funding or the investments we're making as a society, it's a real challenge to make relative investment choices.
So I think some people would argue, I want to put my money in whatever, I'll get all the returns, and then it's my choice, perhaps from a philanthropic standpoint, where I want to put that, and whether it be environmental or social. Why pair the two? Why pair that mission with investing?
So it's a good question. So two answers there. One, the UN Sustainable Development Goals, which were agreed to by all the nations of the world, set a challenge to achieve a just world by 2030. That would be a world we'd all want for our children, to raise our children in today. In order to get there, there is a $40 trillion investment requirement to achieve those Sustainable Development Goals, and every year there's a $2.5 trillion gap relative to what's actually being invested. If you take all the philanthropy, all the foundations, all the family offices, all of them combined, it's $2 trillion. If you take the Gates Foundation, the $65 billion in Gates Foundation, less than 1.5% of the first year gap. So we're not going to get there with traditional philanthropy alone. Philanthropy is a wonderful thing, and it can be extraordinarily catalytic. And much of the research that's been developed that connects the dots for us between outputs and impact came from philanthropic investment. Many of the new models are created in a philanthropic context, but to have the sustainability and scalability to really solve these key challenges that are defined in the 17 UN Sustainable Development Goals, we need the scalability, dynamism, creativity, and energy of business models. And we need investors who are directing their capital against those business models. And that creates dramatic change, scalable change that can meet those targets. And my suspicion is it won't take that level of capital, in fact, because the kind of impact we're seeing across our portfolio is generally running ahead of the underwriting that we committed to in each of our 16 investments that we've made to date.
So I think we're put to task here in terms of closing that gap. I want to give the audience a sense here because you invest across 7 sectors, and that is agriculture and food, education, energy, financial services, healthcare, technology, and infrastructure. We're in a room of potential investors here. Can you give us a sense of how is it going? What's the progress been? I
Yep.
know it's only been about a year since you held your final close, but
Yep.
how's it shaping up?
So it's very encouraging across 2 dimensions. One, as I mentioned, we commit to a level of underwriting of impact, and we measure it with something called an impact multiple of money. So what level of return are we going to deliver relative to the capital we invested in reportable, ultimately auditable social or environmental impact? We actually have KPMG do the assurance work around that, and we had our first impact report come out about 3 weeks ago with assurance. Those impact underwritings are trending well ahead of underwriting, well ahead. So we will deliver very meaningful impact with the RISE Fund, point one. Point two, we've already invested about 50% of the fund, which is sort of stunning. One of the big questions people had when you raise a $2.1 billion impact fund, is there enough investing to do in the impact world?
Especially because these deals tend to be smaller in size.
Well, they're not necessarily. One of the interesting things I explained to people when we were talking about this is the reason impact deals have historically been small is that impact funds have historically been small. So tautologically, if the universe of invested capital is small, you're going to have small deals on the other end of the equation. So we've not had any trouble finding opportunities. And I would say in general, the interest in being part of the RISE Fund on the part of entrepreneurs is extraordinary. I mean, millennials are 2 times more likely to buy a product from an impact company, a company of social purpose, and they're 3 times more likely to work for a company of social purpose. And that's a very encouraging dynamic. And we're seeing it in the way we get access to really exciting opportunities where we can partner with governments, where we can partner with large corporations that have a real mandate about wanting to deliver impact and value the fact that we can deliver a way of measuring it and presenting it to the world in a credible way, as well as to our institutional investors.
So that's a really interesting point, because is there something about today's environment that makes it more receptive to the message behind impact investing? I mean, when we spoke before, you mentioned some of the investors in the RISE Fund really didn't have any impact investment exposure.
No, in fact, the vast majority of the institutional investors have never done any impact investing.
So how did you convince them, and why is now of interest when it comes to impact investing?
So our institutional investors are fiduciaries. At the end of the day, they cannot make a trade-off between return and impact. To the extent we could demonstrate to them that they can make a return and deliver impact, that's obviously a wonderful equation that they are quite excited about. But the vast majority of this fund is capital from the largest institutional sources of capital in the world who very much wanted to be part of this platform. And the beauty of that, it's about $5 trillion of capital sitting around the table that is watching the sausage get made on how we measure impact and how we report on it. And the commitment we have made is that at the end of the day, we will make that impact measurement standard available for others to use. And it would be our hope that everyone in this room would be raising their hand at some point because we believe that this trade-off is not real, this perception that there needs to be a trade-off. In fact, you can invest very dynamically while creating these social or environmental outcomes as long as you have a credible way of measuring it so that it's a truthful measure. So it's not greenwashing, it's instead a real objective measure. And these institutional investors are very excited about what we're doing, and I think we'll assuming we do our job right and continue to deliver, we'll, if anything, and hopefully invest in many more institutions in the space.
Is there a day when impact investing is just good investing? I mean, what's the value of the term? Is it just the fact that we're in this market environment where the social and environmental components aren't always considered to be possible to be married to investment return?
There is great positive impact from businesses in the world, and I'd argue there's great negative impact. We've had lots of conversations of late about certain companies that have, they're creating social dislocation, about products that create ill health, dramatic ill health, et cetera. So I think there will always be a choice for people to make to invest in negative externalities. I think the challenge the human race has had is we are not good at measuring externalities, and I would posit that, and I believe that most of the challenges we face in the world are a function of our inability to integrate those externalities in the way we choose to invest. The very fact that most people keep their money parked in a bank account creates an interesting opportunity cost moral dynamic when, in fact, every investment has an impact. When you have the chance to make a positive impact, it's your obligation to put your money to work and make that positive impact. The world needs it in light of that gap that I talked about a little while ago. So I don't think all investing is impact, but I think what you'll see happen is when we can start measuring it more basically, and I think just as we've come up with standards like GDP or IRR or DPI or all the other measures that we like to throw around in the financial world, we will have similar measures around degree of impact. Paul Pullman made the point a while ago that as someone who's a real pioneer in the sustainable movement, that if you're a company that doesn't create sustainability or isn't part of a positive direction, you probably shouldn't exist. That's his strong view. But the beauty is the markets can choose. People can choose where to put their capital, and we want to create a standard that allows us to at least have an educated choice that we make.
Let's shift gears a bit to talk about the other day job you have, which is managing TPG Growth. You oversee about $13.5 billion in that business. You're invested in companies including Airbnb, Uber, Fender, STX Entertainment, Exojet, and many others. Feels like everyone is talking about growth investing today. You're seeing some of the larger buyout managers come into this space. You have operating partners in very high demand as financial engineering to some extent goes by the wayside as a driver of returns. So how has the market for growth investing changed since you founded TPG Growth just over a decade ago?
Yeah, it's been a dramatic shift that's taken place. The level of disintermediation, disruption is extraordinary today. So as an investor, historically, you could underwrite a macro dynamic and then assume that when I sold on average in 3 to 5 years to somebody else or took a company public, that company could then persevere under the same underwritten macro dynamic for another 3 to 5 years for the next buyer's underwriting. If you think about radio, it took 40 years for radio to get to 50 million people. It took Pokemon Go 2 days to get to 50 million people. So the combination of mobility, software as a service, big data, analytics, AI, those three have enabled a level of disruption and change across all the industries that we focus on. All the sectors that we focus on as a firm. And we do both large-scale investing in our TPG Capital Group as well as innovation and disruption and growth investing in TPG Growth. And you've seen it in retail, you've seen it in media. We invest in a lot of media innovation in a platform called Evolution Media, where we're looking at new technologies and new ways of both distributing and creating content across all forms of media. So the exercise in finding that disruption and innovation and not getting it wrong when the cycle of innovation can be a couple of years is a huge challenge, but it's also an enormous opportunity to be part of a re-engineering of our industrial system. And I would say it also applies to the developing world. We just invested in a company in Africa called Cellulant, which is delivering a mobile payments, mobile credit solution across 12 countries in Africa. There are more people with mobile phones, more people that have mobile phones than have bank accounts in the rest of the world. And the possibility to access people, given what's happening in India with Geo and across the continent of Africa, with interesting financial services opportunities, media opportunities, credit underwriting, et cetera, transparency is extraordinary. And that was never possible even a few short years ago. So it's never been a more interesting time to be a growth investor.
And in the remaining minute we have, for the managers out here and the investors out here considering or thinking about impact investing and potentially getting into this space, what's your word of advice, word of caution? What would you tell them?
Well, it goes back to that earlier point. God makes the rain fall on the good and the evil, and the sun shines on the good and the evil. The reality is impact companies are no different than any other company. So the same verve and drive and excellence that people in this room bring to their other companies are the same requirements needed to build great companies that create great social and environmental outcomes. And in that is the hope. When we can take the kind of talent that exists in the investing world, the great entrepreneurs in the world, the great company leaders and others, and drive against these imperatives, that is frankly the only way we're going to address these big issues.
Great. Well, you heard the man. Let's get to it. Thank you all.